I'm going to call the JRIB meeting now to order. It is, I don't know what time it is.
7:07.
7:07, thank you. And we're going to start with some minutes, last meeting and arrears. April 23rd, regular meeting, and June 25th.
I'll make a motion that we approve the minutes for April 23rd and June 25th.
Okay, do I have a second?
Second.
Tom, second? Any comments or questions, revisions, et cetera? Okay, all in favor of accepting those minutes? Aye?
Aye.
Nays? Abstentions? Okay, unanimous. We will now move on to BlackRock. We're going to hear the investment performance reporting and some investment objective and risk appetite workshop information. So I will turn it over to our OCIO.
Thanks, Ken. Good to see you all again on this very last but very pleasant week of August. We'll talk about our quarterly performance, the last quarter of your fiscal year, and actualize within the broader fiscal year as a whole. I have some information on asset values and some interim performance of the last 6 or so weeks of the years as well. Pretty packed agenda because the second item on investment objectives, risk appetite workshop is really the prelude to an SAA, a strategic asset allocation review that we hope to bring to the JRIB in October. So hopefully much of the meeting spent on the second piece, but obviously happy to answer any questions, thoughts, concerns that you all have about markets, about performance as we go through the overall portfolio performance. So just kicking off on page 2 is the high-level summary with the 3-month and fiscal year to date.
By the way, thank you, because this is really getting a lot better. Summary is excellent.
Yes, good, excellent. Just to contextualize performance as a whole, it was an exceptional end to the fourth quarter for you, the second calendar quarter. Low double-digit returns across equities, spread across regions. It was the U.S. up 11, non-U.S. equities up 12%, driving a lot of the overall performance of the portfolios. On a calendar year-to-date basis, the U.S. equity has actually been dragging non-U.S. equities, right? Non-U.S. equities had a pretty exceptional rally, especially in Europe and Japan at the start of the year. Non-U.S. equities were up about 19% year-to-date from just in 2025. U.S. equities only up 6%. So the rally in this second quarter, calendar quarter for the U.S. equities turned U.S. equity returns positive. It was actually, we've just experienced the 4th best May through July in U.S. equities since 1950. 8 of those 9 of the top 9 periods have had positive performance for the remainder of the year. So hopefully that bodes well for the portfolio through the end of the calendar year as well. The Treasury curve is also a lot steeper than it was at the beginning of the year, so fixed income assets had some positive returns for the quarter, as well as the front end of the yield curve has come down. The market's been pricing in that the Fed is going to cut. We're now up to an 89%, or we'll round that to 90% likely outcome that the Fed makes a rate cut in September. So that's being priced at the front end of the curve. Obviously, we have tariff policy, uncertainty around inflation. The One Big Beautiful Bill Act that passed in July has led to a disconnect from the short end and the long end. So the long end rates have stayed elevated and in fact have increased a little bit. You don't really own long bonds, but that has obviously implications for longer term rates, things that are tied to the 10-year Treasury rate, where the pivot in the yield curve really has been around that 10-year point. Obviously, tariffs and Liberation Day, that was kind of the highlight of the quarter that started the quarter. Within a couple of days, we had the 90-day pause. We really ran into some immutable economic laws that supply chains aren't going to all of a sudden onshore manufacturing within a couple of days or a couple of months, and also U.S. debt. And that was actually the big trigger around the Liberation Day, was the fact that there was a little bit of consternation that foreign buyers of U.S. debt were starting to sell assets, or at least not buying U.S. treasuries. And that has implications for the longer end of the curve. We've seen the U.S. dollar weaken substantially since the beginning of the year. And so all of these are going to continue to be at play. We we continue to expect inflation to increase from where we are today, that we'll start to see these prices come in. But the spread out of the impact of the One Big Beautiful Bill Act may have some near-term positive implications for growth. The idea that we're seeing tax cuts, that there's a lot of tax cuts, especially around CapEx spending. So if we think about where is all the CapEx spending going right now, it's into AI, into building data centers, and into building AI models. And if you get a nice little tax break, that should hopefully be enough to stir a bit of growth in the economy and offset some of the inflation. Very tough job for Chairman Powell to have over the next couple of months of trying to kind of thread the needle again between what looked like a weakening job market, the revisions that we saw for May and June, where hundreds of thousands of job creation was cut down to 30 or 40,000. We're starting to see a bit weakness there, but wages haven't really taken a hit. We're still seeing somewhere between 3 and 4% wage growth. So that's this whole how much of the labor market and the weakening in kind of jobs and job postings and job turnover, while wages are still high, may mean that the economy actually is performing pretty strongly. And then we're not as concerned about a weakening economy in that case. So a lot that'll happen. Chairman Powell obviously was a bit more dovish at Jackson Hole last week, clearly indicating why the market is pricing in at least one cut. The amount of cuts for the rest of the year has varied widely. Across the street, there's some banks thinking that we're going to see 3 to 4 cuts in the next couple of months. We stand that there's going to be 1, maybe 2 cuts, and we'll likely see a total of 5 or 6 through the end of next year. Most of the cuts probably happening next year. But still, the equity markets have continued to rally. Looking at the actual performance of the portfolios, the quarter performance for the pension fund up 7%, leading to a fiscal year performance of almost 12%. Your target, again, is 6.9, so very healthily above the targeted expected
There's
return.
one very happy person at this table, sitting to your left.
Yeah.
Okay. Big return.
Yeah, very healthy returns. In the fixed income space, obviously, again, the return driven by the sizable equity allocations. On the fixed income side, ag bonds were only up about 1% for the quarter, excuse me. Non-US fixed income, unhedged, up 8%. Hedged, only up 2%. So the weakening dollar is a headwind for hedging your non-US exposures. You're unhedged on the equity side, so you're generating that tailwind from a weakening US dollar, and kind of getting returns in foreign currency dollars is beneficial, or has been beneficial, especially all year as non-US equities have rallied. Assets as of the end of June were $492.5 million. As of the end of July, they were $507.8 million. That includes a $15 million contribution that the town made in July, as well as the reduction from $2 3/4 million benefit payment outflows. July was about a 0.6% return for the month. Through yesterday, your assets are $517.1 million. That's a 1.8% return for the month of August to date, a total of 2.4% so far for the fiscal year. So off to another strong start. That would be great to continue to see throughout the quarter, throughout the year. On the OPEB side,
Josh, before we move to OPEB, is the cash figure performance for the fiscal year accurate?
so the cash return, we do a holdings-based return. The STIF fund that you're in, the cash fund that you're in, pays interest after month end. So when we reinvest, so you have $100,000 in cash, on a day, you get, whatever the monthly interest is, but it doesn't get paid until the following month, and we've reinvested the cash. You see this weird return that looks high. You're generating the cash return in this STIF fund that you have, which at the beginning of this year was, somewhere around 4.25%, 4.5% is kind of what the STIF fund is paying. So this is just
So it's
a
a
holdings
function of when
base.
the actual cash.
Yeah,
is
when the
received.
interest actually gets
The interest
paid, which is,
Okay.
we don't do the accrual return. Interest is paid after month end.
Cash flow based.
Yeah, and we tend to reinvest that cash. So a bit of a weird pop on that, yeah.
Can I make a suggestion I think is relevant? I think situations like that, we should put an asterisk or
Yeah, no, I
a star
totally agree.
and with, or something, because it's $185,000, it's not meaningful or relevant, but I have to go to the Board of Finance quarterly and all this stuff, and I guarantee you, just to be troublesome, somebody's gonna raise, oh, we're making 34% on your cash. I mean,
Move everything to cash.
yeah, exactly, so, I'm sorry, this is on tape, I apologize, but,
He'll get the question.
yeah, guaranteed, guaranteed.
And
So,
we're gonna move all your assets to Kent. No.
yeah, so let's see if we can,
Yes.
whenever we have something that's
Yeah.
clearly,
Yeah, we'll footnote,
Right.
especially on this page.
and
yeah.
let me ask you one other housekeeping type question, and I think it's pretty obvious that markets have been great, so I think we should move, to the extent possible, to the meat of the meeting, unless people have other questions about performance. Mine is more of a housekeeping question. Are the alternatives numbers up to date? I thought they always lag, so
So
how?
our private equity
Yeah.
NAVs are as of March 31st. We reflect in it transactions, so you've made, and, I can go through on the pension, we've made some capital calls, so some of the NAV is bumped because we've put more money into the fund, as HarborVest is called money. We've received some distributions that actually almost offset. We've received about $1 million from one of the Mesero funds and made about a $1.8 million capital call to the HarborVest fund. So that's the only change in the NAVs. We expect to see the June 30th statements from private equity this week or next week would be.
You don't think it'll significantly change these numbers?
Well, so I was going to say, again, we track the performance as we have data. I would suspect that your private markets, and when we see the individual funds through 3/31, the quarterly performances for especially the Mesero and the Lexington funds were closer to 1%. I'd expect there to be a bit of a bump for the June 30th, just given how strong the equity market returns were.
So
But there is that lag, so it is that quarterly lag. So
You can add on, you know more about this than I do. My only question is, so this report, in other words, if I go to the Board of Finance with this report, it's not actually technically exactly accurate, is that correct? On the alternatives? Or am I missing?
Well, I'm just gonna say, it's the same conversation that I feel like we have every 2 or 3
I'm
months.
just talking, I'm talking practically now, I'm not
Yeah.
making any judgments.
But like, every quarter we get a report, and every quarter, the privates are always lagged a quarter.
Right,
And so there's always gonna be like, oh, yes, second quarter was strong, and they probably made a little bit of money, so it's gonna be bumped up. It could go the other way, but it's always gonna be lagged a quarter.
right.
yeah, that's right.
So just,
Definitely, I'm just trying to think about how to present that.
Well, I think
That's
your
all.
earlier suggestion on a footnote would make sense. I mean, I hate to clutter things up with footnotes myself, but in this case, it's a matter of accuracy. It's a 3-month lag, so I wanted to say so. It's good for educating people
Yeah.
who haven't heard the explanation before.
That the private equity return is a 3-month lag return. It is that
Right.
most up-to-date return that we have.
Yes, or something like that, right.
That comes
right.
into the-
So this way I can, when I say it, it's supported by a footnote.
Yeah.
Okay.
Just a quick question,
Yeah.
on calls. Have they been coming pretty much as scheduled, or as, I guess as expected, if people are finding enough to do?
So, yes, I mean, I think the HarborVest funds are the only funds that you have that have really outstanding calls. One of the Mesero funds is pretty much invested. There might be a call here or there if they find something interesting for the last part of that fund life. And what we're seeing is the HarborVest funds themselves have been making calls across a variety. If you recall, you're in a fund of funds, so they allocate across private equity equity subcategories. So they have primaries fund where they're investing in another fund. They have a secondaries fund where they're buying private equity, and they have a co-investment where they're making investments. You're making investments in conjunction with HarborVest into a direct company. So we've seen a mix. Most of the recent capital calls have been more towards the secondary side, which is where the market is much more active. I'll have to go back and see what their expectation for this most recent call. We just made it in July. We made another call on one of the funds. But it seems that they're kind of going across secondaries. They're using a bit on their primary side. So there are deals to be made. There has been an uptick over the last 6 months, more so in the last quarter in M&A and IPO activity. So the PE market is picking up, especially on that primaries and co-investment side. So they're not necessarily relying on kind of finding good secondary deals, but it's kind of being deployed across their base.
Good to hear.
Jumping through, page 4 is the summary. We went through the NAV history, and I gave you the updated again. As of end of July, you were at 508 versus the 493 at end of June and 517 most recently. So a nice upward trajectory in the portfolio assets. In terms of the individual underlying holdings, again, in the pension, on the liquid portfolio, that's your equities and fixed income. You own both collective trust funds and iShares. That's why there's the two lighter lines. I hope I know one of the feedback last time was darken some of the subcategories. So, within U.S. equities, you're split between the collective fund and the iShares. But again, these are all index-based funds. So the tracking error or that active return relative to the index is pretty marginal. As expected, and the liquid portfolio as a whole tracks the benchmark basically to what you're invested in. So not much deviation as is kind of expected. Again, I pointed out, if you look down at the bottom, the ag bond return 1%, the non-U.S. ag bond, the funds returned a collective 2%. Again, the unhedged version of these funds returned closer to 8%, and that's kind of the environment that we're in. We're starting to see a weakening dollar, so as you hedge back, you lose some of the return on the asset class from the currency hedge.
Josh, one other thing, just quickly, just from a presentation for you. So you did a better job with the shading. So the white are the actual investments, and the shaded are the indexes or the
total categories.
Yes, exactly. So I appreciate that. So the BlackRock Russell 3000 Index Fund, that's the collective trust.
That's right.
So why don't we label that? Okay. Anything that's a collective trust, let's label collective trust.
In terms of the private markets, the alternatives on the other side, again, given that the print of the private equity especially is 331s, not 630s, the return of your private equity book at 475. You'll notice there is a benchmark in here for the eFront private equity index. That's kind of the median private equity of the thousands of private equity funds that they track, also on a quarterly lag. So that is at a 331 return number. So your private equity book is better than median for the quarter. And on a fiscal year, kind of 1 year basis, also better than the kind of average or median private equity fund within this total index. A lot of that's driven by the HarborVest funds. We have seen, capital calls ramp up in those funds. Most of that return that you'll see on the 3-month basis, especially in the HarborVest, just driven by valuation change. They've kind of updated their valuations. They've appreciated in value. This is just on a lot of their co-investment. So there's been a bigger uptick in M&A and IPO activity. So a bit more comparison. They have an investment in a healthcare company, and a couple of healthcare companies have gone public. They now have a market price that they can kind of set a valuation or comparative valuation. So you're starting to see some appreciation as the market is starting to open up a bit more for M&A. As I mentioned, we got some distributions, 1.1 million from the Mesirow 6 fund. So you see the NAV has actually come down even though they have a positive return for the quarter. And it's just because we got a very large distribution from Mesirow that we actually then used to fund a capital call that we got in July. So that's kind of as the nature of these go, that as we get distributions, we'll either reinvest. If we have cash and no capital calls, we'll reinvest it in the liquid portfolio. But if we do get a capital call, we'll just take the cash that we get and make the capital call with it. More or less a bit more de minimis distributions that we've seen from some of the smaller funds that we've seen. And like I said, HarborVest 2023 had a call. That's the one that I have. HarborVest 2023 had a call in April, 1.5 million. And the HarborVest 2022 had a 1.8 million capital call in April.
Not to dwell on the, like Tom was saying, on the footnote thing, but because I had to explain it last time, that little Lexington at the bottom.
Yep.
With the negative 67 and all that stuff. Let's see if we could put 1 or 2 sentences with a note. So.
Yep.
And I think also if your returns are, if it's the final number from the quarter before, a note of that too, right?
Yeah, any footnotes that we throw in on the on that high-level summary we can add to the performance pages.
Yeah, that'd be good.
I'll make sure.
We'll say big swings, because you have the one Harbor Vest with a 31% return. You know, what was the driver? Could have been just a couple companies, IPO or.
Yeah, that's they as they wrote up some holdings, they haven't spun anything out. They've had a couple of things that other funds have bought off of them. A couple of funds, they've had a couple of co-investments that other funds have bought off them, so they've been able to mark up those higher returns. If you'll notice the NAV, HarborVest 2023, as of March, you were 1.7 million, but we actually have been making calls in the 2023 fund. For most of the fiscal year, we've made a couple. So some of those returns are a nice markup on a very small NAV that you hadn't made a ton of commitments to yet. And as you've built up those capital calls, those are just holdings-based returns. So you saw a nice return in a quarter that we had a low starting NAV that you generated the return. That's going to lead to that higher number.
On the more subjective side, do you track your confidence in marks to market of various PE companies and people in alts in general? Does BlackRock have or do you personally take a view on the adequacy of marks?
I mean, I don't personally distrust. I mean, it's all independent third-party audit of kind of the valuations. I mean, the private equity company is going to use a variety of ways that they can value public company comparisons.
Would it be fair to say that when you add HarborVest or Mezro to your platform, that you review their valuation policy and valuation committee and that sort of thing, and get comfort that way? Just to your question.
Yeah, that's a great, but you inherited this, so I'm wondering if that's a.
Yes, maybe.
Yeah, so we have a bit more care. We're not necessarily doing due diligence and telling you HarborVest is, we got to get rid of them, they're cheating. I mean, we're very aware HarborVest is a very well-respected company in the private equity industry. We have our private equity team that knows all of these managers, and then some, right, the team that was here in June, talked about the BlackRock platform as a whole and the relationships that we have across the industry. They haven't flagged, they reviewed the whole portfolio when we came in June, and they didn't have anything to flag on anything questionable about the way that these companies are valuing their underlying portfolio holdings. But we can also do another.
Do you go see managers when you take on legacy investments?
When we take on,
Probably already have coverage on HarborVest, I would guess.
yeah, so typically we don't. So the way that we've the way that we're covering the private markets, we're not having somebody go do due diligence on your specific funds. We're in a care and maintenance, so we are going to make all the capital calls, all the distributions, all the reporting, work with the manager to make sure that we have the right reporting.
It's not like you can redeem.
Yeah, I mean, if there was a desire to redeem, we can certainly work with you to help either find a replacement or to just do the redemption to invest it somewhere else. As we go through the SAA, if that is an outcome that there's less private equity and we need to make an adjustment, like that's something that we would work with you on. But in terms of the legacy holdings that you've invested in the past, we have not kind of said this is bad, done the diligence, say this is bad, we need to get out. But like I said, the private equity team did do a look through the book when we came in June, and again, they have relationships with all of these managers. They know these managers. They're pretty well respected, very long track record managers. So nothing untowards, I would think, of any of these managers.
Just a quick question. As more and more of these companies are being born out of private equity and less of these companies are transitioning to the public markets, how is that changing the private equity landscape, and how is BlackRock evaluating that?
Yeah, so I mean, that's a big rationale for staying invested in the asset class itself, as companies are staying private for a lot longer. So access to certain things. I mean, the 20th most valuable company right now is OpenAI, right? At their valuation, SpaceX is also up there, all private and very unlikely to go public as a whole. And so, that's one of the attractive, I think, characteristics of the industry itself, is that there's going to be wholesale industries that are just not going to make it into the S&P or going to make it into the Russell 3000 that you're going to be able to own in an index, and you're going to have to find a way to own it or not own it and not participate. I think that's a big kind of economic megaforce trend that BlackRock is very behind, is kind of both the private equity side and private infrastructure side are kind of the two big things. The AI build out, that is clearly something that is going to drive the economy, that's going to drive markets. And yeah, there's public companies that participate, right? You can invest in Google and Meta and NVIDIA, but a lot of the kind of second wind of the AI movement, right? Some of the software that might come out of this might not be public for 10, 15 years or might not be public ever. And if that's the forward trend, the way you access these companies is through private equity. So we're constructive of private equity, and kind of the infrastructure build out that's going to have to go through that is also going to be a public-private partnership.
I didn't know, like, at some point in the future, the duration of the J curve will be spread out. You know, than we're normally accustomed to.
Yeah, I see your question on, you know, is there now going to be an elongated investment period? I don't know if I haven't.
I guess I'm kind of asking, is BlackRock having that internal conversation?
Yeah.
Well, I guess by default, you know, and look at the market dynamics of like public markets somewhat on the equity side getting smaller and private markets getting larger. We're responding with, in the last 18 months, you've seen significant acquisitions on the private market side to be able to kind of address that entire life spectrum, the investment spectrum. Because you are seeing that move, and public market, private markets, that line is starting to blur. And we're going to see that happen more and more.
We could touch on the historical again. We highlight on page 7 the fiscal year return, very strong. You now see at the 3 and the 5 year period. You've also out-earned the long-term expected return, so that's also a good that's a good outcome that we've seen from, you know, the recent market rallies that we've experienced. You know, I do have this, you know, flip note on my side here of the private equity. The last 3 years have been very tough for the asset class as a whole. Rates have gone up. There's been slowing of M&A. There's been slowing of deals, slowing of activity. Funds are extending their lifespans. Total returns from the asset class have been lower. But at the longer term history, the private equity allocation you've had has been very strong, out-earning and outpacing the public equity side of things. So it's a tale of two interest rate environments and tale of two environments of private equity, but the fiscal year to date return at least is seeing a bit more of a recovery. There was a bit of a lull in late 2022 into 23 and into early 24. So a nice pickup, you know, where again, as I said, constructive of the private equity asset class, just given where companies are staying private longer and what types of companies you might be able to have access to that you don't have access to, and the ability to see some of that valuation increase. But public markets have just ripped for 3 years. Your equity portfolio up almost 17% on a 3-year basis and 13% on a 5-year basis are driving this return above the 6.9% bogey. We can skip to the OPEB. You know, I talked about the performance, or I didn't really talk about the performance, but on an asset side, you had $102.5 million in assets at the end of June on the OPEB. As of the end of July, that was $103.3 million, so a 0.8% return. It has a slightly higher equity allocation than the pension. That's driving a bit of the better return. And then through yesterday, you have $105.8 million in the OPEB for a 2.4%. Monthly return, 3.2% on a fiscal year. So it's outpacing the pension by about 80 basis points in terms of total return. And again, you have more equities there. The only private equity in the portfolio is the HarborVest funds, which have done very well. And you know, the longer dated, the more legacy private equity that's, you know, a bit more in runoff mode on some of those older funds has had lower returns that we expect to see a bounce back in the June 30th numbers, but at least through to date, the higher equity allocation, the primarily HarborVest allocation in the OPEB is leading to the difference in returns there. I'll pause there. Are there any other questions on portfolio performance, the allocation? I'm happy to answer any market questions.
Quick question. I know you guys just had your privates team in here, so sorry I'm asking this now they're not here. Are you putting anyone into registered funds on the private side? You know, there's been like an uptick in registered funds that are basically the same structure with the primary, secondary, you know, what have you. Just be curious if you're
Yeah, kind of a bit more like liquid, publicly traded. So we
Like a quarterly or like an annual tender or something like that?
Yeah, so we do have both in private equity and private credit funds that do that. You see a bit more pickup in that in kind of retail side. A lot of them are typically marketed to, and I know some of our fund investors are kind of first-time private equity. You know, you have a bit more liquidity in the portfolio. There's quarterly openings, so if it's not something that you want to do, there's a quarterly out. You know, so those exist, and we have seen use cases for it and clients investing in it, especially on the private credit side. We've seen a big pickup in kind of the wealth side, ultra high net worth individuals that want access to private credit are using some of these. They trade as BDC funds. They look like a 40 Act, but they have, you know, the.
Josh, you got it, you're speaking Chinese to most of us.
Yeah, it's just a structure of the fund. It's a structure of the fund. It looks more like a mutual fund than a private equity vehicle, right? That you have all these subscription documents, you're in, and that's it. You're stuck, you can't ever get out. These types of vehicles have quarterly redemption windows, so you'll get a notice on a quarterly basis, kind of not, you know, two months before the end of the quarter of, do you want your money, yes or no? You say yes, they'll give you your money. It looks more like the real estate fund that you're in, kind of an open-end fund with quarterly. Similar thing though, right? There is gating on these types of private markets. So if you want a full redemption, you might only get 50% of your money back.
It sounds like similar to a REIT, an REIT.
It's not the
structure.
So a REIT is more of an equity. It's more of the fund. Your principal real estate fund is more of an open-end fund. So the subscription is just always open. You can always send them money. They'll never turn that down. There's no like one time, hey, we're open and then we close and no more money. So it's an evergreen, so it's always open. And then once you're in the fund, there are redemption windows, so you can get your money back. Similar again to the real estate fund. There's a quarterly opening. You have to hit a deadline. You can request your money.
You can't get it all because it's in other.
Well, you could. It depends. If everyone's trying to get their money out, they're not going to give everyone 100% of their money.
Because it's on like a mutual fund or something where they
It's- yeah, it's-
sell.
Yeah, so it's like the real estate fund. You remember when Principal came in, they talked about they had cash, they had liquidity, but they were looking to invest. The rest of the fund is invested in physical real estate, in private equity fund or private credit fund. Most of the assets are invested in the same types of funds and deals that are in the HarborVest structure that you're in, for example, right? Like they have funds of funds that they've committed to. You can't get your money back, but they do keep a liquidity sleeve so that they have cash that they can transact. There may be a bigger pickup in these types of structures, right? You've seen the executive order that is kind of pushing private equity and private assets in general into 401k plans, who are much more liquid investors, right? There's a lot more trading that you might see in those types of investments. And so these funds have a bit more liquidity and have a bit more of a liquid sleeve.
It feels like your question's about more thematic about the liquidity in the private markets, and is that getting better?
Yes and no.
I mean, there's a lot of work being done on it, and you've seen probably headlines, 401ks, retail wanting more access to private markets, but there is a liquidity element to it that is tough to get around, right? It's an illiquid market. And so there's a lot of work, I know, being done at BlackRock, but a lot of the firms, because it is a growth area for a lot of the firms, potentially, because it's a very sizable market.
So that makes sense. So, but on the RIC side, for instance, you wouldn't, the registered fund side, you're seeing much less institutional adoption there because you would probably make the argument that you're better off in a typical private equity fund because the returns are,
Who we are.
And I think also the investment horizon, right? I mean, you can make an argument that a 25-year-old investing in their 401k can't touch that money, and so they should be able to more liquid vehicle. But a pension fund theoretically is thinking, I need to invest this money for 30, 40, 80 years. My participants are going to live for a long time. And so I have the ability to kind of sit on some illiquidity and take the illiquidity premium that comes along with being invested and trying to target companies that you might not be able to sell tomorrow. So you do tend to see the kind of these registered vehicles being used much more by investors who, might change their mind in 3 years.
right. Yeah, I was just curious to see if you're putting, or I guess pushing or suggesting to any OCI.
I mean, if it fits, I have a client on the private credit vehicle, that's the avenue they went. They need monthly valuations on their private credit. They have a benefit formula structure that requires a monthly asset value, and they didn't want to try and figure out the go-around of these quarterly lags in valuations. And so the private credit fund that we have is monthly value. And so they get a monthly value at the end of the month, at the end of every month. So, yeah.
Well, the argument is some of this may become more common as the number of stocks starts to diminish and more companies stay private longer, but then also in that, I mean, you mentioned the 401, but Start Engine and all these other ways that people are tapping in and moving equity. There's a lot more flow in the private side now.
Yeah.
But if you don't have any of these, you're just going to be completely out of the game on major companies that exist now.
I'm not sure
He's just talking about private companies staying private longer.
Yeah, like you want to be in
Yeah.
SpaceX, you almost have to go to these types of vehicles, as an example.
Yeah, private market vehicles, but the liquid vehicles are making investments. Oftentimes, the deal will be split amongst all of their funds, or specific deals will go into that fund itself. Especially these registered private equity vehicles, most of the assets are in similar allocations that the private fund, like the HarborVest fund that you're in.
I think it's not to boil it down, it's an interesting question. I think the reason it wouldn't be for us, and I'm always looking for liquidity, right, is that the only time we're looking for liquidity is when this is not going to have it either. So it doesn't make a difference. It's not like they're magicians or they're doing something different. So if we really needed liquidity, it's going to be the time when they're going to have the gates down. So it doesn't make a difference.
Yeah, that's very fair.
Yeah. So.
Any other questions? We can jump into the risk investment objective and risk workshop. A lot to cover here. A lot of ideas, and I'm very happy at the attendance that we have today, because I feel like everyone should have their opportunity to have their voice heard.
Well, it's only because we're bringing in cake later on.
Sign me up for that too. So on page 26, I guess on page 26, I'll just go over the kind of three high-level objectives. One is defining objectives. We should spend most of our time talking about what our objectives are, coming to some agreement. You have a lot of your objectives already documented in your IPS, and I assume there's not going to be a lot of deviation from the broad objectives that you have. But it's still good to have all of your voices heard on some of the risks that you're worried about, especially around liquidity or return targeting. We should definitely have that conversation. The asset allocation discussion, there's no portfolio that we're recommending here. That's going to come in October. The asset allocation discussion is just to bring forward, here's BlackRock's capital market assumptions, the relationship to the return target that you have currently, and bringing up ideas of, hey, there's a lot of levers that we're going to look at when we review the asset allocation. Are there things that people are uncomfortable with that we should just not consider for the asset allocation review? Should we consider everything? And we can make a decision in October that this sounds good, this doesn't sound good. I think after the first section, we may have ideas on things that are just off the table and things that are, that sounds interesting, maybe we can consider that. And then lastly, governance. The governance part, we'll talk a little bit about benchmarking, how we want to think about following the portfolio over time. We do meet quarterly, or kind of every other month. We talk a lot about quarterly performance, and it's great to track this most recent quarter. You're all long-term investors here. You're thinking about meeting a long-term expected rate of return. You're talking about meeting benefit payments that aren't going to come due till 2050 or 2080. And we should be taking that kind of long-term horizon and thinking about how do we want to benchmark. But you also have stakeholders in the town and the Board of Finance who might ask questions about what happened this quarter, what happened this year. And so we should be able to reasonably look at the portfolio and be able to explain, did we meet our job or did we not meet our job, and what can we do better? So that's all covered here. It's a lot of ideas and topics. We're not going to have all of the answers today, but we should be putting our cards on the table, and we'll have hopefully all of the answers. On page 27 is kind of the outline of the next steps. So today is the risk workshop. On the next meeting in October, we'll bring asset allocation options that we'll vote on, or I won't vote, but you'll all vote. And we'll have, based on today's conversation, maybe some risk metrics, return metrics that will help us make that decision. And again, the decision in October could be, we love our asset allocation and everything else is not really moving the needle and we're good, but at least we reviewed it. We document that we reviewed it, what were the reasons that we did one thing or another. And that you'll make an approval of whatever the decision is. And then in December, at the more administrative meeting, that's where we can bring the IPS just for review. If there's edits, obviously if you're not making changes to the SAA, there might be very minimal edits to the IPS, but it's still worth putting a set of fresh eyes. There's a fair number of new people on the board since we were hired, only a little over a year ago. And if there are changes at that meeting, we can decide on when will we implement this portfolio. What is the timing? If there's not huge changes and it's all liquid, probably be able to do it that month, but it's going to depend on all of the decisions that we make. So at the bottom, one key question before we get to October, and this was something that we did last year, and I know it was kind of a false start of reviewing the asset allocation, but we did have a subcommittee last summer where some people on my team met with. Nick was on it, Eric was on it, Tom was on it, Ken joined partway through there. Don't need to vote today, but sometime this week and into early next week, if there's people who want to be part of the kind of sausage making of here's all of the modeling, here's all of the asset allocations, I'm happy to have as many of you that want to join that. Otherwise, if we'll see you in October then with here's a couple of portfolio options, and based on the metrics that you care about or that you think are the most important for making this decision, here's how the portfolios compare. We can then make.
Is there a third option on that, which would be progress reports between now and then as you're working?
We can do that. We can do that as well. I can share with the JRIA itself.
I would think that would be, considering how big a decision this is, and given the limited amount of time, I'm not sure a small select group could really be doing anything productive in such a short time, as opposed to you guys doing your work and maybe updating us just a little bit, maybe a couple of times. We're thinking this, or this is the direction. Here's some things we're looking at. Here's some themes, and allow people to respond. And also, if it's a reply all thing, I'm not even sure. Man, I don't think we're allowed to do that from an FOI, right? So we'll have to think about that. But
that's also.
I'm actually open to board opinion on that. I'm just not sure that this particular thing lends itself to a.
I think with our minds being on getting to a fairly aggressive timetable, that would make sense, because if we went halfway down and somebody said, well,
Right.
it kind of happened last time.
Right, right.
Without judging the merits of the discussion, but it happened last time. We got pretty far down the road on a decision, and a concern was raised that set us back a significant amount of time. So I think that is a great suggestion. I think it would reduce the likelihood of that. People wouldn't be surprised. Other people who haven't been necessarily contributing ideas.
We can always add a special meeting too if we have to.
Good point. It's a big issue. That's a great point. Yep.
Okay. All right. Okay. All right. Into the defining objective section. On page 30, we've today talked a fair bit about kind of being a public pension investor, the long-term horizon that we have. I think that's an important mindset to remember to be in. At the bottom, we compare a couple of different types of investors. And I know everyone here is likely an individual investor versus a public pension versus other types of institutions. An endowment is probably most similar to a public pension in terms of the longevity. I think one of the things that separates public pensions from all of these types of investors is kind of twofold. One, the basic pension finance. You owe benefits. These are obligations that you've promised to participants, to employees of the town, employees of the police and, department and fire departments, and you have to fund those. And the only way that you can fund that is the town can pay all of it, which is very costly if you add up all of those promised future cash flows. But the idea is you have a pension fund, you've invested it, and you can use investment returns to offset the need for the town to find the funds to pay those benefits as they come due. You have a long-term return target, so your actuary works with you. They do the valuation on an annual basis. They help put you on kind of a long-term budget plan. As long as you hit your expected return, the contributions are pretty much known. For most pension funds, there's not a ton of liability changes year over year. Your population is generally pretty steady and the assumptions are generally pretty good. And so your levers that you're controlling are funding versus investment return. That's not the case for a lot of other types of investors. An individual has an accumulation phase. I'm trying to maximize my wealth. And then all of a sudden, as soon as I retire, my investment decision kind of changes. Oh, now I need to decumulate all of the assets that I have. And maybe that's a different investment portfolio. Yours is a constant need for return. The liquidity piece is also extremely important. But back to the bigger point of what separates pension funding is the last piece is kind of governance and oversight. You're making decisions here, but it's on behalf of the town as a whole. You have stakeholders that you are responsible to confirm that we're doing a good job. They see the long-term return assumption. As long as we're meeting that expectation and the financing of the portfolio is on track, that's a good outcome. And we have to think about what is a good outcome. And a good outcome is kind of meeting those expectations, getting the return that you need, keeping the financing of the portfolio and of the contributions kind of known and budgeted and not as volatile. So a lot of this is going to be focusing on asset liability management, and that plays into a lot of things. But let's remember to keep this long-term outlook hat on as we think through our objectives, what risks we're worried about, and the liquidity needs of the fund. So on 31, this is where we'll start to open up the discussion. There's kind of 4 key elements that might help us shape an asset allocation. Number 1 is the return objective. So you have a long-term return objective. You're kind of contingent on this expected return outcome. It's 6.9%. This is actually a good portfolio comparison metric. And one of the things that I would recommend that we look at when we look at asset allocations and various asset allocations is kind of medium to long-term horizon. What's the probability that we hit that return? We don't want to pick a portfolio that, over the long run is going to undershoot that 6.9%. We want to think about how do we achieve and attain that variety of risk measures that we can kind of pull together in an asset allocation review, but kind of that long-term bogey is a key investment objective. I'll pause there. Has anyone thought about or kind of had thoughts on, are there other objectives kind of from the return? Like, what do we want the portfolio to do over the long term outside of we have a return target, we have to fund these benefits?
Sort of tied to that, I think, is managing and mitigating risk.
Right, so we want to make sure we're doing this in a prudent way is a good way to manage this work. So I think that's a good thing to add. And we have the risk tolerance piece, and maybe the return objective really isn't that controversial here. You've kind of set the long-term return objective, and one of the other things in public pensions that that we've seen this trend on is the decrease of expected returns over time as capital market assumptions have evolved. So your expected return is not extremely aggressive. If you talk to your actuary and they look at what is the return bands, we're seeing a lot of public pensions start moving closer to 6.5. But again, you can achieve asset allocations that return 6.9. You've done it over the last 3 and 5 years. So maybe the next step to think about is the risk tolerance. So doing this in a prudent way, that is the IPS kind of defining pretty generally that we should do this prudently, we should meet benefit payments. What are the things, this is the what keeps you up at night about the portfolio, about the fund. And we can start to think about ways that we can try and avoid or at least lessen and dampen those risks.
When it comes to at the town level, how much do we get into we want to hit our 6.9%. We want to do it like a really low volatility, so we don't have, I'm assuming for the Board of Finance, like a large funding ratio, funding ratio volatility or contribution volatility, right? Like if we hit that number over 10 years, but we have 1 year where we have poor performance, like what does that actually do at the town level when we're looking at the Board of Finance, like what contributions we have to make? That's something I don't know, but exactly how it plays into, but
Well,
it would be a good
the
thing.
smoothing aspect of the way.
Yeah, how is the smoothing aspect? Yeah.
Well, typically, it's come at the worst time too, right?
Yeah.
So if it happens in a downturn, then the budget crunches at the day.
Yeah,
It's usually at the same time.
So minimizing that potential volatility on the town.
Yeah.
Yeah, because of risk tolerance.
Yeah, and sometimes that's hard to put a number on, like a drawdown risk. And, we can certainly express kind of a worst-case contribution outcome or contribution volatility number as a way to see how smooth you are in terms of not putting the town in a position where it's a bad equity market, which tends to lead to, job loss, lower tax base. Like, do you have the revenue to then make bigger contributions?
Josh, it seems relevant to talk about at some point, not now, variance in return relative to what? I mean, relative to the markets, relative to projections, relative to itself. I mean, there are lots of ways to measure variance at the risk of saying the obvious. It'd be interesting to know what the board collectively, by consensus, thinks really matters.
Well, it strikes me that they should actually converge, because I think I hear, because if we're being responsible in setting the discount rate should reflect a realistic assumption about the future returns in the marketplace, right? If we're being responsible.
Yeah.
So it converts.
Return though, but variation along the way is what I think.
Oh, I'm sorry, I thought you'd move to the next.
No, I'm just talking about variability. So if we can get to 6.9 in a zigzag way or a relatively smooth way, relative to markets, relative to itself.
Isn't that the benchmark that we come up with ultimately?
Is it a benchmark? Is it relative to itself?
Yeah, okay. Yeah, so I mean, definitely we should be thinking about, and in the governance section, we can talk a bit more about how are we going to accurately, or kind of, maybe not accurate is the right way to phrase it, but kind of how do we put a return target bogey, if you will, that makes sense for what we're trying to do? Is it 6.9%, which may be very optimistic and the portfolio is not going to achieve that and we'll see underperformance, or maybe it's a naive benchmark of.
Let me be concrete. Let's say we were underperforming the S&P or whatever the benchmark is by 35 basis points all the time. Is that a big loss?
Yeah.
Or if we see volatility, the zigzag type performance over time, is that a big problem? I mean, I think if we went around the table, we'd find different people saying different things. I might say, if we exceed the benchmarks, we're doing great. Others might say, well, if we're down 20%, that's really bad. Somebody else might say, well, the S&P is down 30%, so 20% down is a win.
Yeah.
Might have different.
So I think there's two components there. So maybe 33, just really quickly, this is a little bit of the pension finance math, because I think this gets a little bit to your point of, do I care about zigzag, or if I'm just always 30 basis points underneath some bogey benchmark, or above would be great. There's a lot of information on here. The high level point from kind of this pension finance is the one big key point that you have is the return target that you set should be reasonable and attainable, because it's more important that over the long term you achieve this return. So if you look at the bottom left is a good illustration. You smooth your assets for a lot of variety of calculations that the actuary does, importantly the contributions. So big swings in the market get smoothed out. You smooth things out over 5 years. And so on the left-hand side of that bottom chart is, if there is a market return of 6.9%, that black bar is kind of what your expectation of the assets are. If you earned 16.9%, you out-earned your bogey by 10%, your assets end up kind of, this is with benefit payments coming out of plus 6 or 7% above. If you under-earn that, there's a downside outcome there. But if you look at the right-hand side, the actuarial value of assets is smooth. The volatility is much more muted. So you might be okay if we looked at a portfolio that has a 14% annualized volatility versus a 12% annualized volatility. That difference in volatility on an annual basis might not make much of a difference, because the ultimate impact on what the cost of the town is on a 1 year you smooth out all of these losses, it's not as impactful. But what the right-hand side, the bottom right chart shows, this is actually a great exhibit from your actuary. So if you undershoot your expected return by 50 basis points, that's the dark green dashed line, or by 100 basis points, that's the lighter green circle dashed line, you actually come home to roost 15 years from now, where the expected contribution ends up being exceptionally higher than what you were planning to do because you've consistently underachieved this expected return.
So it's always been a financial experiment of mine to watch the OPEB operate and the pension fund operate in parallel. And you always see consistently the OPEB do better than the pension fund. And it didn't have alternatives, it didn't have real estate. And when we had this discussion about it really is a 60-year time horizon that we're dealing with here, can we absorb the volatility to achieve those higher rates? When I came on 07, dating myself, discount rate was 8.5. So, you know, I think I'm a little bit more on the, listen, I'm welcoming volatility to get the downrange gain. That's where I'm at.
Payouts, you know, is the OPEB paying out at this point? If it's not paying out, you're just accumulating assets. Is certain, one of the town size a closed plan where, you know, the last one who got hired in a pension plan on a contract, well, they could be here 30 years. That young person, last one in, you know, eventually you have to, decades later versus, okay, somebody's been in here, they retired 10 years ago and, you know, so it all depends and then the funding level. If we're well-funded, overfunded, does the town stop making those contributions? Or they continue and keep it overfunded, bringing down the risk?
And that's actually a good, you know, point. You know, from a long-term goal, the plans are underfunded. The pension fund better funded, obviously, than the OPEB fund, but you're still at, you know, in the low 80s funded. So there's a while to go to get to fully funded. But you know, a long-term objective, right? 15, 20 years from now could be we want to see a modest surplus. We like a rainy day fund for, you know, offsetting a 15% drawdown one year. Well, we've built up a nice little tiny surplus. You can make a decision further down the road that if you've built up a little surplus or you're fully funded, you know, do you take some risk off the table and we can be less aggressive. We don't need to shoot for a higher target. Where it stands now at 6.9%, you still have 15 to 20 year runway to get to fully funded. So any returns above 6.9% are helpful for that down the road, recognizing in an annual volatility, like you might see a pullback of funded status that might correct itself in a up market. But what really matters is over 15 or 20 years, you need to hit 6.9%. Otherwise, you're going to find that the town is going to need to pay more in contributions because the shortfall has not been erased as quickly as you had kind of estimated today.
Where we've seen the big hits is when we're having those experience studies and we're talking about, those have been the big deltas, right? When we come and getting back to death, we see those mobility tables, which we're constantly updating every 2 years. We're getting killed there. So those are the things that we really need to predict.
That's actually, that's a good risk. Is there a buffer that we kind of need to achieve? So let's say we have a 6.9% expected return target. Do we build in a little buffer for the total portfolio expected return? Because we'd like to build up some buffer because people are living longer.
I mean, a buffer in that case means taking more risk.
I mean, potentially, but.
Which is fine, but I mean, let's remember everybody at the table here that there's no Santa Claus here, right? If we want to make 7.1 versus 6.9, we've got to adjust our allocations.
That's right.
To a slightly more risky profile.
That's right.
However you want to define, risk is another issue, but that's beside the point. But I think at the end of the day, these are all great conversations. I always joke around that when they do these surveys of investors, they do it all the time. They ask me, what would happen if the market dropped 30%? And everybody says the same thing. Oh, that would be fabulous. I'd love that to happen. I'd be able to buy things cheaper. I'd load up. And then when it actually happens, everybody freaks out and sells at the bottom. And I mean everybody except maybe Warren Buffett. And it's the same thing here in the sense that it's easy for us to talk about in concept what is the right thing to do. And the right thing to do is what Tom was implying, which is to look at this as a very long-term project and not really worry too much about the volatility from year to year or even 5 years, to tell you the truth. But we do have a Board of Finance, we do have taxpayers, we do have newspapers and so forth and so on. And there are implications to having a couple of down years. And I thought you actually made the best statement of all by the way. No, you did. I know it's impossible to believe, but you did, which is that in a year when the stock market's down 30%, being down 20 would be a blowout, unbelievable performance. But that's not gonna make anybody happy. So that to me is the real essence of what our risk management means, which is, are we trying to simply, slightly outperform our blended benchmark, that is, a blend of the indexes that underlie our allocations? Or are we trying to add in an additional layer to prevent that kind of calamity? Even if you say to me, that might cost you some significant performance lag, right? You know what I'm saying? It'll cost you 1% a year, so to speak, to figure out some insurance to never have that happen. That may be something we have to do, even though from a purely investment point of view, it's probably not the right thing to do.
I'm not sure what part of the discussion this would fall into, but where do we put the mindset of the board in the future board? That we're talking about what we're all thinking about today into now, and the risk that we're thinking about now. In 5 years, Eric might be gone, and he's not here. This whole board might turn over, and then we've got a whole different board that has a different mindset. So how does that factor into this?
That's a great question. What does the evolution of that look like? I think from experience in this portfolio in general, there's been an evolution as new board members join, a change in asset allocation, avoidance of certain asset classes or managers or what have you from.
Or changing the political tenor of the town. That can happen in.
And I think having some principles to stand on, your actuary is your friend. Your actuary is helping the town figure out what are reasonable assumptions that we can make. What does that imply from a future cost perspective? I would assume the town's biggest concern would be, I'm gonna have to write you wrote a $15 million check in July. Is that check 20 million in the future? What decisions have been made that got you to a point where budgeted contributions or the thought of what the size of these are in the future? And so kind of standing on, we think that this is a reasonable asset allocation or reasonable return target. We're trying to achieve this return. We're doing this because the long-term outlook is we want to make sure we get to this place. And maybe there's some mark of there are certain losses or certain environments we want to avoid, to Ken's point of, or Tom's point, like, do we prefer to be down 20 when the market's down 30? On page 35, one of the things that I think will be good to compare portfolio outcomes is stress test, is different market environments, where we can turn to, look, we picked the portfolio because it has a high probability of meeting this return target that the actuaries helped us set, that we want to achieve, that we think is a reasonable long-term assumption that gets us reasonable long-term budgeting of contributions. And we picked this portfolio because the difference between them is one has a 60% chance of meeting it and the other is a 57% chance or 55% chance. But look at a COVID bubble again or a tech bubble again. It saves us 10% in the drawdown versus the other one.
This slide is a great slide, 35. I was there in 08, and I remember that. I lived through that.
Yeah, and I think putting a number on it, it's hard to risk budget a tail risk. How much am I willing to draw down? What we can do as part of this kind of drawdown analysis of what if there's a year like this? What is the impact on a contribution this year? What if it happens 10 years from now? And how much does that blow out potential contributions? And is there maybe a limit that we want to get? Obviously, we can't predict what the drawdown in COVID or GFC is exactly going to be, but we know how assets reacted. We know how a portfolio, whether it has diversification or not, reacts. And we're going to make an allocation decision if this is our biggest pain point is, okay, we want to be able to achieve our return, but a big marker for me for picking a portfolio is I want to avoid or have less drawdown. So in a credit crisis, right, this portfolio, your pension fund, as it's constructed today, down 29%. Equity markets were down 40%. So to your out, you beat out, but that's why you're not 100% invested in equities, even if the long-term equity return has been extremely great. There was a rational decision of, in the moment, I don't want to be down 40%. How are we going to fund benefit payments? Where are we going to find liquidity? I think that that's a key part of making a decision on an asset allocation. So it does seem like considering tail risks is probably a big component of this volatility, to the point of you know, if we look at, not to bounce around too much, but if we look at 32, if you look at the two portfolios today, I do this every day, and the difference between 11% volatility and 13.6 volatility, like I'm programmed to say, well, I prefer the portfolio that has less volatility if I can achieve a similar return. I think we've kind of noticed, and one thing that we can produce for this SAA review is, you know, changing this annual volatility. What does that impact 5 years from now? Kind of at a 25th and a 75th percentile, or 1 or 2 standard deviation of contributions. And I'm going to bet that if you have portfolios that are this close in volatility, those ranges of outcomes are not going to be that dissimilar in the near term. But over the long term, if you keep hitting the bottom end of this standard deviation, you're going to be 2% underperformed on a 15-year basis. Like, that's a bad outcome. And so it seems like if we focus on long-term outcomes, likelihood of meeting those outcomes, and can we build a portfolio that also avoids bigger drawdowns than if we were in just all equities, or, you know, a portfolio that just has a slightly lower drawdown risk? Because I think it does.
It's interesting, and I'm not trying to suggest a solution at all, but as I look at the bottom right quadrant about underperformance, it's pretty clear that a drag on investment performance is a bad thing, and the town has to pay for that, obviously, at the end of the day. But then when you look at slide 35, it's kind of stark. It runs looks right in, you're looking at it right in the face. So it seems very dramatic. But the underperformance, it's kind of like, oh, it's one quadrant of, I'm not criticizing PowerPoint formatting, but it's like one quadrant of one page, and it's mentioned again in defining contributions. I guess what I'm saying is risk is used here on the investment side on the drawdowns potential, but less on the underperformance side potentially. It's less dramatic anyway. Let's put it that way. Or they're both risks.
Yeah, I mean, that is fair. Having a just consistent 50 basis point underperformance of my target is a risk.
Yeah.
And again, metrics, like we can compare portfolios, and this may be your current portfolio under BlackRock's capital market assumptions expects to earn 7.1. Maybe we need to target something like 7.3 or 7.4, like get a little bit more risk.
My point is, we sometimes, and I'll do it myself probably, we talk about conservative portfolios and aggressive portfolios. But interestingly enough, the risk on the conservative portfolio, what people might think is a conservative portfolio, is different but serious.
It could be a drag.
It could be a drag on performance that the town's going to have to pay for,
exactly,
which is real money.
Yeah, no, exactly. And I think that it's a very important metric of thinking about, am I likely to, right? These expected returns, this is a median outcome.
So I think to Eric's point earlier, if we can express risk in different ways, including the risk of not making our bogeys and having the town have to pony up more money than it thought, versus an explicit loss on an equity portfolio, which seems easier to understand, maybe, but it's the same money out of pocket. Each dollar is a U.S. George Washington on it either way.
I mean, I think definitely both important things to consider, and we won't have an idea until we see how it plays out, but one could sway the other. If there's just this drag of underperformance over the long term, like that is substantial capital. A one-time drawdown loss, I mean, we've seen from all of these risks, like living through 08, notwithstanding the funds, but a 30% drawdown was met with a 30% plus recovery, and so it's a short-lived versus the long-lived. And I think that'll be important to play out. To continue to flip through, not to also cut, are we comfortable, I guess, with having discussed some of the downside risks? I do want to touch on liquidity a little bit. I know we've talked about our private market assets, the concerns of kind of the reporting side, transparency side notwithstanding, but if we think about liquidity as a whole in the portfolios are pretty liquid. I mean, there's certainly been instances in the past that I think have burned the town and the board, and that has led to kind of the direction that you're in now. We have several frameworks. We certainly think that you're in a fine spot. Like, there's no need to say we need 0% illiquidity from just the liquidity perspective. Like, you have enough assets, there's a drawdown, the liquidity profile analysis on the left-hand side of 37, if there was a drawdown and you can't get out of your illiquid assets, you need almost a 70% decline in your liquid assets for you to trigger only having 3 years worth of benefit payments left. Like, that's a huge drawdown. So you have plenty of liquidity in the portfolio, and then some. There's certainly the ability, and public pensions are investing in private markets, corporate pensions, but that doesn't necessarily have to be for the board. Just to put your caps on terms of liquidity, that's certainly been a risk and a concern for sure. Is the level of liquidity that you have now kind of this huge drawdown? I know we have a metric for the OPEB. I know the benefits aren't coming out of the fund for the OPEB currently, but if they were, it's a similar story. You have plenty of liquidity for a massive, massive drawdown on the liquid portfolio to still be able to meet the benefits. You'll still pay out your benefits. Is there, I guess, what other concerns, I guess, are around liquidity, or is more of the concern with private markets around just cost, transparency?
I think, at least for myself, the concerns on the alternatives and the privates is not in the concept or in even the conceptual, idea behind it in terms of, private companies. I think, to me, at least personally, liquidity, this is a good chart. This does give me a little more comfort. It quantifies a little more what, in terms of what the implications would be of a major event that would potentially make the illiquidity be an issue. But I think personally, my concern going forward in terms of our future, we're locked into a certain amount of what we have and any commitments, so we can't really make those kind of changes, but is that every Tom, Dick, and Harry is piling into this. There's not a single meeting going on in the country right now that is having the exact same conversation we are. And now what scares me personally, I'm just speaking for myself, is this business where these products are being dumped into 401k plans and so forth, which to me tells me this is late stage and these are very smart guys. They've run out of suckers to buy this, so now it's going to be dumped on individuals. That's just my opinion. So that's not to say I'm saying zero or run for the exits. I'm just saying that if you ask me what the big concern is since we're making decisions about what our allocations will look like for the next whatever 20 years, 10 years, I'm just questioning the product and what I see happening.
Is that specific private equity also, or all kind of privates? I mean, there's a wide range of
That's definitely
real
true.
estate,
Yeah,
infrastructure.
without question. I mean, I think of it as an entire blob, but private equity strikes me as the one that I just can't, if I read one more article about how glorious it is and it's so great and it's, all these companies are staying private longer and blah, blah, blah. And then I see it being dumped on so inappropriately, at least in my opinion, or 401k plan. I mean, it's just, seems almost shocking to me, actually. And again, I don't know, that doesn't mean anything, actually, but I do think it's a data point. I mean, it is a change. This used to be something that was for the use of high net worth, sophisticated investors and so forth, and now it's going to be everywhere. And it strikes me it can't be that special going forward. And also, everybody's a private equity manager, right? There's probably 20 in this room that I don't know about who are in that business. So it's just like, whatever, Paul Tudor Jones was the first famous hedge fund manager or something 40 years ago. I mean, now there's 10 trillion. It's probably more hedge funds than there are stocks. I'm not sure that's true, but I wouldn't be surprised if it's actually the case. I know there's more mutual funds than there are stocks. That's a fact. I don't know about hedge funds.
But to your point, a lot of these investments, you literally have to basically sign, like, you could lose all of this and you're just perfectly fine, which,
Well,
the average 401k investor isn't, and this fund.
That's an all
isn't
mutual
either.
fund.
But we're at like a
Buy
point,
anything.
yeah.
a little bit more on that
I mean,
side.
I mean, the product is the product. I don't think we have to get into, that part, again, not to dwell on it, I just feel that, put it this way, the product has changed. It's not what it was 20 years ago. It's not what it was 10 years ago. Right? It's not the exclusive domain of a handful of very sophisticated investors and very sophisticated fund managers. It's now the province of everybody on both sides, the manager side and the investor
To
side.
be fair, retail isn't going into these blue chip funds either, though, right? I mean, that's pretty much only institutional investors still.
That's even sadder. From a bigger picture, right?
And on the flip side of that, right, now in the public markets, we have concentration risk. Right?
Big
We've never
time.
seen a bigger segment of the S&P 500 dominated by just a few companies. So that's the flip side of that.
No, it's a very good point, and it actually raises a point that Josh and I spoke about, which is at least having the board aware of the opportunity to do equal weight versus cap weighted on indexing. I'm not advocating for one versus the other, but people should know that there are ways to do it that don't mean you're exposed, like Eric's saying, to 40% of the index being 10 companies or whatever the numbers are. Which hasn't, by the way, been a better performer over the last 10, 20 years, but it might be going forward. And
It was better last year, but
oh, is that right?
way underperforming this year.
Right. But I'm just saying, if we're talking risk management, and given the amount of indexing we have,
Concentration
it is
risk.
worth at least understanding it and knowing there are ways to address it.
Yeah.
You're not stuck with that.
Concentration risk. There's that level of diversification, so, both equal weight versus cap weight, regional diversification, asset class diversification, making sure your total portfolio isn't 40% five
All or
companies, there's ways to kind of think through that while the implementation part is also interesting, is definitely important to think about. Any other thoughts? We'll have the asset allocation part in a second that, we'll list out asset classes. We can strike them, we can include them. That'll be part of that conversation. Really, the point here was the liquidity piece in that, not advocating yes or no, but, our analysis, like the fund could take on more illiquidity risk. That might be a third rail. We're very well aware of history and kind of what happens when you're illiquid and can't get funds. And so that is I think that is one of the trade-off thoughts to think about, when it comes to liquidity. And there could be a desire for, we don't want any illiquidity and we should start exiting the illiquid assets. That is an option.
I think the real question for the board should be, are we being paid for the illiquidity? There's no reason to take it if we don't think we're being paid for it. Right? If you told me, I think, Ken, we can get the same returns as the S&P with privates, I hope everybody would agree that makes no sense. In other words, I think as a board, we have to be convinced there's outperformance, private versus public, illiquid versus liquid.
Yeah.
Or else I hope nobody would
That's
advocate for.
That's Green 40, that's the.
Say what?
That's the essence of Green 40. I mean, where are we being paid?
Yeah.
Yeah, totally agree.
Yeah. And certainly from, private equity is probably the most commonly thought through of benchmarking, and when our private equity team was in, the emphasis on, top quartile managers are very much outperforming public equity. There is that alpha opportunity from finding the right managers. But there is a wide range of outcomes, and the average manager is not necessarily outperforming, at least recently outperforming. Different periods of time, the average manager in private equity was outperforming, but that has ebbed and flowed, and currently we're in a position where it's not. So that is definitely an important part when you're thinking about the private market asset classes. They're much more expensive, and are you being rewarded for the fees and the illiquidity component? And we stand behind yes, that you are rewarded for that.
Could I ask a question that I'm not looking for an answer right now, but I'd love to hear the answer over time. How often does BlackRock, on behalf of its clients, fire a manager where the asset class you still believe in? So hypothetically, in real estate, for example, you say, you know what, town of Fairfield or town of wherever, we still like real estate. Maybe you don't, but let's say you did. We still like real estate, but we need to get you out of this manager. It goes back to my question about your confidence in Marks, because I come from that world. I remember Marks being really sloppy.
We do. We perform due diligence on hundreds of managers.
But how often do you say as a consequence?
We have clients right now. We just terminated a non-U.S. equity manager. We do it. That's part of what we're trying to do. If we see underperformance, change in portfolio management thesis. We had a non-U.S. manager that basically got a call wrong on Japan. They've been underweight Japan forever. We said, what are you doing? And they're like, no, the market is definitely wrong on Japan. This is ridiculous, they'll never outperform. And
You didn't buy the
he's
argument.
been eating underperformance for close to 2 years now, and we exited almost a year ago. So we do that, and even on the private equity side, the team that was here in June, I mean, they have their managers, they review their managers. I think Annie even made the comment that, if there's a manager that's, they've always been kind of a middle market healthcare, and that's what their strength is, and all of a sudden they're investing in tech companies, they go, well, that's a big change in philosophy. We don't really believe that you're going to be doing well at that. We're not inviting you to the next round, sorry.
And they definitely try to stay ahead of how the managers are doing, so that it doesn't come as a surprise, last minute, like, what happened for it? Like, they start monitoring, like, is there a shift in styles and things that is not what they committed to.
Quick question, back to the liquidity profiles. Is there much peer data available that you guys have? Because I think you have a slide later that talks about
Peer benchmarking.
peer comparisons, and if we could have something there that talks about how others are pushing the liquidity, I don't know if that's available.
Good point.
Yeah, let me look. There's a lot of information available at bigger
Right.
public pension, which obviously their liquidity profile is going to look a lot different. They're the big public pensions that are going into a lot of alternatives. Let me see what we can pull around portfolio allocations and the like in terms of size.
Milliman may be able to get that for us too, so we
Yeah.
can get some of the surrounding communities. I know that they run
Yeah.
a discount rate run annually, so that's not a bad idea.
Yeah, it would be good to partner, because I know that Jen is pretty connected actuarially to the kind of Connecticut, municipal pension systems as well.
There's a big difference between the large states.
Yeah,
West,
exactly.
big cities.
Yeah, you want to
in
Fairfield
County
think
or
about peer,
Connecticut
not to
municipal, very different.
jump all the way ahead to there, but you
Right.
definitely want to think if you're going to do peer comparison, what is a
Right.
relevant comparison? And comparing yourselves to the state of Connecticut pension is probably not the best.
Different, and
Right.
got compared to municipal.
We're also a member of NCPERS, I can get you their annual report.
Okay, I think that's been a very robust discussion on kind of the risk tolerance, the investment objectives. We have two other sections. Is there anything that anyone else wanted to bring up from returns, from risk?
I don't know if this is the forum for it, but what's BlackRock and your outlook just on AI in general? I mean, is it at the point in 5 years, or we just have two AIs talking to each other, and that's whoever's got the better AI is going to be the winner here? So I'm just curious how you see that developing and how that strategy is going to be in our long-term look at this.
Yeah. So it's actually interesting because we just have 3 economic scenarios from CMA. We have a baseline, like what is kind of standard CMA expectations, and we have one with significant AI pickup. Not necessarily, we're not thinking that as a scenario as AI is coming together. It's more, it's more in what is the increase in productivity, what is the future investment needs of industries that will support AI and the AI build out, and what does that mean at the sectoral level from equity level returns? What does that ultimately then translate back into the debt market side? I mean, we're obviously pretty bullish on AI kind of leading to much more of a productivity gain. So in those scenarios, there's an upside to returns in general.
I understand that part of it in terms of how it's going to affect, the day-to-day life, but talking about you as our managers or other managers relying on AI more to make their moves and look at, and then again, eventually it's AI versus AI, or everyone's on the same wavelength, and then where are the market, where are the ability to make some money in there?
Yeah, I mean, I don't think BlackRock's alone in, I don't know if you have more on.
So we have signed a enterprise level relationship with OpenAI that gives us a lot more security and kind of having the kind of walled garden inside of BlackRock. And so the investment teams now all have access to it. They're going to start standardizing what should be done, but they're all playing with it right now. Because it's in its infancy still.
Yeah, no, totally. But I mean, it's going to grow very quickly. So again, what we're talking about 5 years from now, 10 years from now, it could be.
Yeah, they're using it and trying to figure out how it helps. Like an example is like the amount of research reports coming into BlackRock. No one can read all that, right? And so how do we get themes coming out of those research reports? AI can do that in about 30 seconds. So it's things like that they want to try to use and apply. to be able to apply to their investment philosophy overall. But they're going to standardize it and kind of in terms, what are the best practices that all these investment teams have come across, and what can we use kind of going forward, so.
Okay, I'm just thinking longer term.
Yeah.
A bit more focused on kind of how to synthesize research and come up with investment ideas.
Yeah.
I can't speak to, is BlackRock going to fire me? And
Well, no, that's what I mean, yeah, but I'm talking about the
But-
human element that comes out of the investment and
Yeah,
that.
is it going to be an AI agent at BlackRock making an investment decision and trading against an
Right,
AI
or
agent?
are your managers, or maybe
Yeah.
even unbeknownst to you, I mean, are saying that,
Yeah.
there's a guy that you're talking to on the phone, but.
Yeah, I mean, I suspect, especially our manager research team is going to add AI questions around their due diligence. How are managers using due diligence? What are they doing? And then making an assessment on, do you trust that from an investment process?
Right.
Yes or no? And BlackRock's going to have their own philosophy, as Ray was alluding to. Like, there's nothing set in stone yet of what we're going to do. I mean, there's a chance you spend a year, testing and putting AI together, and it's just not the right tool to make investment decisions. It's a great tool to summarize research, but it's not going to make investment decisions. That's unclear so far, and I think that's unclear within the market. There's a lot of speculation that it is going to be very beneficial to everyone, but how that actually plays out, I think, is still pretty unforeseen.
You're comfortable, we're not going to have to say, every time we have a question, we'll have to say, "Hey Siri," and then ask the question.
I may just have to respond. I'll have to use ChatGPT a little bit more to understand how they frame their responses. So in terms of asset allocation, I'll keep this section relatively brief. You can see the table on page 40. The solid line going across is the expected return target. So there aren't a lot of asset classes that outperform. So there is this need, and obviously your portfolios are tilted into equities, right? You have 50% in the pension plus another 10% in private equity. The OPEB is 65% plus another 10% in private equity, kind of leading towards your return there. But there are other asset classes. If you look at the blob of green dots in the lower left, the two fixed income asset classes you're in are the two most bottom returning asset classes, just an ag fixed income, kind of general fixed income. So there are other ways that we can diversify the portfolio, both from a return seeking kind of the equity side of the portfolio, as well as the fixed income side of the portfolio that might be able to generate that return. You can see the two red diamonds, the pension portfolio a tick above that line at 7.1, the OPEB portfolio at 7.3, a tick above that line. So one of the things that we'll be doing is putting together mixes of portfolios for you to review and understand, but there's going to be this list of asset classes. Not necessarily that we need to include them all, that's part of what we'll talk about in a second, but on page 41 is really kind of the process that we'll look at. So you're going to see mixes of portfolios, a number of drivers, and one of the things we can talk about here is we can mix drivers, or we can say, hey, I'm interested, and as this process develops, hear more. One is we might need to increase equities, right? Our portfolios right now are barely above the line. That might mean we need a bit more equity risk to generate those higher returns. The second part that I was alluding to is additional asset classes, providing additional return, especially on the fixed income side. How does that work in relation to other asset classes? The kind of correlation, this consideration focus on the incremental benefit. Is it providing me a better risk-adjusted return? Am I able to boost my return for the dollar, for the risk that it needs to go up? Is that a reasonable trade-off for me to take? Usually diversifying your portfolio tends to, help lower some risk, the correlation benefits, but not always. So I think the first two columns will be things we should definitely be considering.
Okay,
I just want to ask a question because in the latest asset class, digital assets, right? Now, I'm not suggesting we need to go there, but that is
Yep.
an asset class out there, right?
Yep.
There's a lot of activity there. I think that's something that probably needs to be addressed in the policy or somewhere, right?
I mean, certainly, investors are definitely picking it up. BlackRock has a paper out that kind of sized what a allocation to Bitcoin could be and how you risk size it relative to basically owning the top 10 US equities. You could size like a 1% allocation to Bitcoin for the same level of risk.
Are you seeing
So,
any
on the retail, and
is the activity mostly on the retail, or are you seeing any of the
Yeah, so-
other pensions or anywhere
so
going
we-
near this stuff?
So we've seen some bigger public pensions by the ETF, by the IBIT, the Bitcoin ETF. Some of it's around, it's not really been in like a risk mitigation perspective, it's been a kind of a return generation component of it. But the actual institutional pickup has been less than on the retail side. So you're seeing a lot more interest, you know, if you're thinking about big investors from family offices that are more interested, younger generations coming in and they're interested in digital assets, owning Bitcoin, Ethereum, you know, whether they're owning physical coins or they're owning the ETFs. From the pension side, and Ray, I don't know if you're.
We just haven't seen it in the SAA yet. You know, perhaps like if there's an opportunistic part of the SAA, maybe there, but not as an official asset class within the SAA. We haven't seen that. I know of like one institution that's relatively small, a public pension, and they have like a 50 basis point position to digital
That's
assets.
probably a very
Yeah.
small position, right? Because, yeah.
About endowments? Endowments look at it any differently?
I'm trying to think of some of our clients, if we've seen it. You know, to Ray's point on like opportunistic, you know, we'll see if there's a, you know, a tech play or a risk on play. You might see it picked up as a small allocation usually through the ETF.
Yeah, because there's the liquidity there.
Yeah. But again, from an SAA perspective, hasn't been picked up at that level yet.
Am I reading right that you have 30-year expected return of US equities right on top of our 6.9%?
Yeah, I believe it's, actually, I think the return is in the back. I can't remember if it's
It doesn't matter if it's
6.9 or,
exactly.
yeah,
Yeah.
that's exactly right.
So
It's
how-
US large cap equities.
So, right, so how would, going back to what you were saying before, I mean, it just raises questions. I mean, really, what it really raises questions is about the 6.9, actually. You were saying if we wanted to, juice is the wrong word, we were trying to figure out a way to get a little better expected return. You said you might want to increase the equity. How would that help us if it's right on, top of our?
Yeah, well, it's, you know, there's the global equity dot. So, you know, we'd probably think about allocating your equities across global equities. You know, there's still the international exposure, which is generally higher returning. That's, from a capital market perspective, it's valuation driven, right? The P's in Europe are 12x and US it's 23x. So from a valuation kind of reversion perspective, a bit more attractive long-term return from non-US equities. But, you know, in general, I would say those red dots are kind of about where you are thinking from an equity perspective. The long-term non-US equity is not like we're going to earn 10 versus 7. It's, you know, you might get 7.5.
I mean, this is actually a very good, I think this is a terrific, I mean, obviously, it's only a projection, there's no reality here, but this is actually very valuable. What this is telling me is that, based on your projections, the privates, which you have BlackRock has a much higher, depending on what you're choosing, private credit, infrastructure, equity, higher expected returns. A smaller amount of that is offsetting a larger amount of the fixed income, and sort of bring us right back to the 6.9, which is where the stocks are.
Yep.
And, which actually doesn't bother me very much. I mean, I think the board should, I mean, the fixed income is not there necessarily for its return.
Yeah.
Right? Traditionally, it's been there as ballast and diversification. Now, some of that relationship has gone away, or has, at least temporarily, has gone away. It used to be when the stock.
return is now a bit more attractive than,
Yeah,
maybe
the
not an
return-
ag fixed
Yeah, the
income.
yield is, but I mean, in the olden days, when the stock market was down 800 points, for some reason, you knew your bonds had had a great day. It no longer is necessarily the case. That also is probably a pretty important piece of information too, in terms of constructing the portfolio and what purpose fixed income is providing.
Yeah.
Going forward.
Yeah. Again, in terms of the levers, I think portfolios should explore increasing equity, additional asset classes, to that point on the private markets, that last column. We can certainly look at portfolios that have more liquidity, diverse exposures, not just let's go all into private equity. Maybe there's other asset classes that are attractive. There might need to be some more education, especially if we talk about, say, private infrastructure. As an example, there might need to be a bit more education before making a decision that, like, yes, that's a good SAA decision to have, but certainly worth seeing portfolios that have a variety of allocations, I think. thematically, one with a bit more diverse illiquids might be useful. I think the columns 3 and 4 are probably the ones that have maybe the most diametric opinions and views on. But another way to increase returns is if you believe in active management, you can have a passive return of 6.9, and if you expect to achieve another 50 or 60 basis points of active management net of fee, that's a way to achieve a higher return than 6.9. Often active management might be uncorrelated in that you're looking more at lower downside capture. So when markets go down, you want your manager to only go down 80% of how much the index has gone down, as a way to kind of avoid some of that drawdown. Obviously, upside capture is very useful. When markets go up, you want to go up more, but that downside capture could be an important, useful tool from an active management perspective. If we go back a year, one of the areas, when Barclay was here, one of the areas we talked about is fixed income especially, is a very attractive time to be active. There's a lot of places to generate yield, lower risk yield, higher returns that way, and we're seeing a lot of active managers beat the ag benchmark, for example. So a thing to consider, but I leave that on the table. I know that has had strong opinions in the past, and we don't necessarily have to adopt active management with this SAA or the IPS update. That can be a longer term conversation as well. But just these are the levers that we tend to see on. Capital market assumptions are around your long-term expected return, and if we need another 30, 40, 50 basis points of return, we have all these levers at our disposal. So maybe just on the, yep.
And what about, just one other ask, futures and commodities for the diversification piece and, not and the correlation difference?
Yeah, so, commodities that had been in the portfolio, that does exist. It's generally there from a diversification perspective. It's mostly impacted by inflation. The returns in non-inflationary environments are not great and tends to be detracting. It's not on here. Our capital market assumption for commodities is very low. But it's certainly an asset class that can be looked at. Often you're seeing a commodity index fund is generally very heavy energy and oil dependent. There's other ways that you can generate the returns from that. We have an asset class on here, listed infrastructure, for example, is predominantly utilities. So when energy prices go up, utilities tend to do well. We've seen that actually happen over the last 6 to 12 months, especially this AI build out, the energy prices are going to go up.
That's the listed infrastructure.
Listed infrastructure benefits greatly in that environment. Private infrastructure as well, but listed infrastructure, is a way to express that view as well. It's equities are owning utility companies, but they're generally pretty stable balance sheet and spend. It's energy prices go up, they basically tell you got to pay more for your electricity and natural gas. So captive audience. And then just, maybe on 42, when we talk about asset classes, is there anything in particular people know on an asset class? And I know not listed on here, but also potentially for consideration, depending on if you want to categorize it as active or diversify our hedge funds as well, certainly can be considered, especially if you're thinking about a bigger equity allocation. Having a low beta exposure helps also offset if we think about drawdowns. In theory, I know that also the experience here in some hedge funds has not been that, where markets go down and they help diversify, but hedge funds as an asset class do that in general. But this is, again, just more for, as we think about putting together asset class mixes, is there things that people don't want to see? And maybe you might need to see kind of a first strike of, hey, we're considering these things.
I'd be reluctant of
Yeah.
anybody, I don't want to speak for everybody else, to hard know anything until we have a little more of a detailed presentation from you on what our options are and what the reasons for potentially considering. Obviously, we all have our own biases and preferences, and depending how long you've been on this board or not, experiences. But I don't see anything listed on that right side, which I would hold my hand up and across to, not necessarily.
Yeah, potential additions, world of hedge funds is large. Would you want to, just for our information's sake, add in different subsets of hedge funds, whether you want to get into kind of you have active management in there, but
Yeah, you think
that is very broad.
Is it like event driven? Are you thinking about distressed? Are you thinking about?
Yeah,
I mean, I would say from a fund like this, we'd be.
You do have people that have brought up portfolio. Do we want to hedge against or do something in a portfolio that protects against a 20% down or a greater drawdown? Like what does that actually get into? A lot of people look at whatever crisis risk offset.
Right.
If you're Makita or a different type of liquid alts, trend following stuff. I don't think we won't necessarily. I don't think anybody's going to put it in there. We're going to raise their hand, add to the portfolio, but it's something you want to.
Yeah, we can
include.
Yeah, we
We've
can
definitely seen that from some of the larger pension plans, the crisis risk offset and risk mitigating strategies, type of bucket to really hedge against an equity drawdown.
I know, and we talk about these are different plans, but the state has a large diversifying hedging pool. That's up with K2, but when you get chucked in there, it's trend following, long vol, whatever else.
Yeah, I mean, at the size of the fund, this is drilling way down industry. You're probably looking more at either a liquid alternative solution or a fund or a fund to fund where you're going to be able to allocate to a bunch of different strategies. But there's fund to funds on all kinds of strategies.
Yeah.
But certainly, maybe we'll think about kind of a couple of mixes with some asset classes, not asset classes, and we'll provide a pretty detailed explanation of what's in this, why did we think about this, here's the answers that it comes up with, and how do you compare that? Okay. Last section. Thank you all for bearing with us through all this. I think that this has been very, very useful discussion. The last is the governance part, thinking about benchmarking. The benchmark's not going to be determined at the next meeting. That'll be more codified in the IPS. But we've had a lot of discussion now about the return target, risk target. You do need to think about benchmarking. 45 is just the definition. This is the CFA broad definition. We're not going to come up with a benchmark. I don't think that is something that is ambiguous or unknown or uninvestable. We have a number of different types of benchmarks that we can think of on page 46. And I think it would be useful, and one of the things that we'll add to the report when we make the determination of how we want to benchmark the portfolio is having a number of these line items. So the first one on the top left, the return objective. And Tom, I think this gets at your point of, we'd like to not be underperforming by 30 basis points every year. That's going to lead to a potentially bad outcome. Having that nominal return. I try and bring it up every time we have a performance discussion, comparing your fiscal year return to that target. We can look at longer historical periods as well. I think that's a good return objective target. That's the objective, right, in the IPS. We need to meet the actuarial required rate of return. It's 6.9. It's a pretty easy comparison. I think the right-hand side is, two different ways of slicing how did my portfolio do. The two on the right-hand side will also help us kind of understand how did diversifying strategies, how did a non-equity strategy do. So the top right is this policy benchmark. You remember back in April when we talked about the historic return, we went through all of the return history of the pension fund. And one of the things that we did was we said over time your asset allocation has shifted. And at certain times it looked like a very passive, naive 60-40 or a naive 70-30, and that would be 60 or 70% in equities, 40 or 30% in just fixed income. And that could be a very basic, very cheap way of investing your assets is I'm going to invest in global equities, global fixed income, call it a day. And that's a good type of benchmark. You're just saying this would be a passive, very easy benchmark. We can set it so that the returns are equal. You'll see later we've kind of set up a naive benchmark for your current portfolios. And that would be a very easy way to track every quarter, every year. It's global equity. Well, we were underweight US equity, for example. And that was an easy way to say, well, we lagged the 70-30 because we were slightly under. Or we have our private equity The last 3 years hasn't performed as well, and probably, having 70% in equities would have been better off. So a good way to benchmark, has the diversifying strategies worked or not worked versus just being a broad public market investor. The third one is probably what everyone is pretty familiar with, the strategic asset allocation benchmark. My benchmark is made up of, we have 50% in equities, we have 20% in this, 10% in this, and my benchmark is just the weighted average of all those indexes. You typically see the strategic asset allocation benchmark used kind of in two places. One where there's active management, so it's a good way to say, did my managers do better than the benchmark collectively? Did we do a good job of picking managers? And the second would be if we were making tactical decisions in the portfolio. Did we do a good job of allocating more to equities or less to equities or whatever relative to our strategic asset allocation benchmark, which says we should be 50% equities. If we went 55% equities and equities rallied, you'll see an outperformance to the SAA benchmark. It's a way to track that. Currently, you're an all-passive investor. The top two probably make the most sense. If there were tactical decisions made, I think an SAA benchmark would be a good one. I think if you had active managers, an SAA benchmark would be a good one. It's still okay to want to track an SAA benchmark. You're just going to see a very 0% outperformance because you're very passively invested. So that's a consideration. And the fourth is peer comparisons. There's a lot of ways to do that. Some managers compare a broad index of kind of funds that look like you and track that on a monthly, quarterly, annual, long-term basis. It's a bit harder to kind of track because all investors are different. Your asset allocation compared to another $500 million public pension is going to be pretty different. And that's not necessarily the best way to do it, but it's probably a good thing to do periodically. Whether that's an annual basis or every 3 years, we can look back. Over the last 3 years, we did this. Our asset allocation's been pretty consistent. How has kind of the broad universe done? And it kind of aligns, doing that on like a 2 to 3 year basis also aligns with what we recommend is kind of looking at your asset allocation every kind of 2 to 3 or 4 years. So it'd be good to kind of bring into play, hey, did we do better or worse than some universe? What are we doing? What have they done differently? Is there things that we should reconsider? Also, not necessarily something. I'm just thinking in terms of the governance that you all have. There's people that you're reporting to and required to report to. That might be something that they've asked that they saw another town or saw the state of Connecticut do something and want to know whether or not we're doing that. The reason that we want to think about these measures of success is we have this long-term goal, and what gets us closest to, did we do a good job? Do we need an area of improvement? And I think the top two right now do a good job of doing that. If our focus is, I want to hit 6.9% over a long term, do it prudently. Objective one, did we hit it? Yes or no? That's a pretty yes or no answer. And number two is, did all of the diversification help? Did all of the asset classes that we add help? Did the policy benchmark, would we have been better off as just a naive 70-30 investor? Did that hit the return? So those are things that we'll need to think about as we go through the asset allocation decision is once we have a portfolio, how do we want to measure that success? Some of the illustration on benchmarks 2 and 3 are on page 47, just to kind of clarify that of this policy benchmark versus the SAA benchmark. These are not yours. On 47, that's illustrative. But I thought, interestingly, if we actually did put together for your current SAA, 48 and 49 are what your naive benchmarks are. We think about your SAA target. For private markets, we have to figure out, do a little bit of math on, is this more like an equity? Is this more like a fixed income to come up with what your naive benchmark is? Just to simplify, we're looking at really trying to align the levels of risk. And we think that your pension portfolio aligns right now to, a naive would be a 60% in global equities, 40% in fixed income. And the OPEB is actually 75-25. That's also due, obviously, you have more equities anyway in general in the portfolio, higher private market allocation in the OPEB as well. And I just thought, interestingly, if you thought about that benchmark to this kind of policy benchmark, page 50 actually does the comparison over the last 1, 3, 5, and 10 years. And so the way to interpret that kind of policy type benchmark, thinking we have a bunch of different asset classes, a bunch of different implementations in private markets. What if we were just a 60-40? The performance on the recent term has lagged. That's driven mostly from the real estate has been an underperforming asset class. P has underperformed global equities. And in terms of being a global equity investor, you're actually slightly underweight U.S. equities relative to ACWI. You're about a 60-40 split. ACWI is about 65-35. So obviously the run-up in U.S. equities over the last, until this year, but, for the last 2 or 3 years has led to some of this drag. But on a 5-year basis, you're over. And so this would be a way to compare, we have all these additional asset classes. We've done all this work from an SAA perspective. We could have funded just this naive 60-40 and gotten the 60-40 benchmark returns. And the same thing for the OPEB up the 75-25 level. So I would propose, once we select an SAA and want to codify it, I would actually implement this kind of policy benchmark. We'd include it in the reporting. We'd be able to track then.
Well, it's necessary because it's home base, so to speak.
Exactly.
It's the freebie, right? If we're going to do all this work and we could have done X, we should at least know what X is and to see if it's worthwhile for us to be doing everything else.
That's exactly right. Because, we look at the 1, 3, and 5 year and say, hey, our long-term target was 6.9. Boom, success. We did it. You've out-earned 6.9 in both portfolios over a 1, 3, and 5 year period, so you're on track. But you have all this diversification. It could have been better. And maybe that leads us to, hey, maybe we should reconsider some of the asset allocation or think about what went right, what went wrong, and it helps keep us honest, I think, kind of collectively. BlackRock.
I wonder with the naive benchmarks, whether, I would not have guessed you were talking about global equities and global fixed income. I would have guessed, absent any information, that you were talking about something like the S&P or a broader index, like kind of U.S. or North American equities. I just wonder how you feel about that. I'm surprised a little bit.
You can do U.S. I mean, your equity portfolio is global in nature.
Right.
You've allocated to, you have non-U.S. equity funds. And then the same thing on the fixed income side. There was a decision to allocate to non-U.S. fixed income. Kind of think of the broad market cap of all fixed income investments out there. When we work with clients that have kind of fixed return targets or endowments that are looking at CPI plus 5, for example, we usually keep it at global equities and U.S. ag as the fixed income piece. It can be either. It just comes down to what is the broad kind of bogey that we think we're beating. And we can say we're U.S. investors, it should be U.S. equity and U.S. fixed income. And then part of what, whatever you end up setting the bogey at, this policy benchmark, every performance decision around that then becomes, okay, well, we made the decision to allocate, if we use just U.S. equity and U.S. fixed income, we made the decision to allocate to non-U.S. fixed income. It overperformed or underperformed over the last couple of years, and that's led to this drag versus a benchmark. We typically see the equity piece at least be global because almost all of our clients are investing generally as ACWI. It's, maybe very big home country bias, but it's never 100% U.S. So it was a lot. On the governance piece, I think it's important that we'll keep bringing this up. We'll bring up at the SAA review kind of what would a policy benchmark look like. And I think we would codify that within the IPS in October when we review the IPS. That was a lot. Appreciate it.
No, but
last week of
we
August.
appreciate it because I think without this meeting tonight, the next meeting would have been much more difficult for us to, I think we all have a little bit of an understanding of what at least you're trying to do and how you're going to go about doing it.
Yep.
So I think it's been helpful.
It was a good dialogue. A lot of participation. It was great.
And obviously, if something pops into your head, there's something that is a concern from a return or risk, or you just want to ask more questions, like email us, please.
Well, in the interim, what are the next steps?
So next steps. So at the top, we offered that we could have kind of a subcommittee meet similar to what we did the last time. Sounds like maybe a better approach is we'll take back. It sounds like not open-ended asset allocation, but we're going to come up with a couple of portfolio mixes, give you our advice on what we think is a good step in terms of asset allocation. Everything will be compared to your current, so you'll be able to kind of visualize what is currently happening, what small changes or big changes due to the portfolio. We'll give you some of the metrics, and, you know, I think we anticipate later in September, we can email the JRIB. Maybe Calvin, I believe I have everyone's, I've seen everyone's emails, but if you can just
I'll send them.
send me the emails. We can pass along materials, lots of explanations. I think some of the materials we did last year, we used to have kind of like an opening page that was like a paragraph long of text that was kind of, this is how you should look at the portfolios. And so we'll be very explicit in what you're looking at, what you're trying to do. Maybe it makes sense that the JRIP funnels questions so there's not just like a running email chain. Maybe, we give you materials, say, hey, pick a point person, funnel questions over a week, send them back, and we can come up or make some tweaks. Come prepared for the October 22nd meeting. Depending on what that feedback looks like, maybe we'll have one more round of, we'll send you things. We'll make sure we get you the SAA materials well in advance of October 22nd.
I think Calvin would be the obvious.
Yeah, so you can send them
Okay.
to me and I'll forward them along.
Perfect. So we'll do that, and we'll target for later September for getting you. We have to put our thinking hats on and run our tools. So, all right. That was a lot. Thank you.
What's next? Okay, good. I guess that's nothing. Is there anything else on the agenda from BlackRock?
No. That's it.
Okay. Is there any new or old business that anybody would like to bring up? No? I think that means that we're looking for.
Old business.
Old business.
We still need the.
Yes, we do, yes.
Conflict of interest.
Tom, what are we doing on that?
It was-
Phil was supposed to draft up something. You and I had a call with him?
That's right, we did.
Yeah.
Yeah, we did. I apologize, that's right. Can you maybe
I'll buzz him tomorrow.
pester him? Okay, because we do need to, if we're gonna have one, we gotta do it at some point here. And it's a good point. Yeah, thank you, Nick. Any other old business or new business or any business? Funny business even.
I'll bring up one issue that we've talked about for a couple of years, which is insurance coverage. I did some independent research, and apparently there's statute protecting the board for, I can't remember the standard of negligence that is protected by statute. But apparently, the insurance policy would be on top of statutory protection.
That is my understanding.
Yeah.
But I think one thing I'm gonna suggest, because we talked about this, is that this not be a public discussion in general, discussing limits and coverages and so forth. Just I'm just saying, if you have a question on that, funnel it to me, and then we'll circle in with Tom, and we'll get answers back to the board where appropriate. But there's good reasons not to discuss it.
No, I appreciate that.
Yeah.
This has been going on.
I got you, definitely. But we, that one we have worked on, and I think we have a
Okay.
reasonable handle on it. But if we needed to have an executive session or something to have maybe Tom give us a briefing on what the deal is, I'd be totally in favor of that. In fact, maybe that's a good idea.
Yeah. add that to the
That's
October
kind of what I'm asking you.
Say again?
We can add that to the October meeting.
Well, that might be a busy meeting, but we could. But we should have it sooner than later. How about that? Okay. I'm just thinking how busy October's gonna be, so I'm afraid, I'm reluctant to add. Yeah, I'm reluctant to add anything to that. Anything else? Anything else? Eric, do I have a motion?
I'll make a motion that we adjourn.
Okay, second? Nick? All in favor? Aye. Okay, everybody have a wonderful evening.
Thank you.